Welcome back to the deep dive. Today, we're taking a really close look at two comprehensive sources. Together, they give us a pretty vivid picture of the global financial landscape right now. We're going to track the surprising resilience of digital asset investments. Then we'll zoom right in on the complex policy tightropes being walked by central banks like Mexico's. And all this is happening against a backdrop of, escalating trade tensions and a really unpredictable corporate earnings season starting up. Our mission, like always, is to pull out the most important insights for you, give you those aha moments, and really arm you with the knowledge to feel well informed, but without all the noise.
Exactly. And just to set the stage, we're drawing insights from a July 7th report focusing on institutional Bitcoin investment and also a very broad financial weekly report from July 11th. These give us a fascinating real-time snapshot of what's truly moving the markets.
Okay, let's dive right in then. Digital assets first, Bitcoin, Ethereum, our first source maps this out. What's the big picture look like?
Well, what's really compelling here is this continued bullish trend. It's quite remarkable. Digital asset investment products, mainly led by Bitcoin, they actually surpassed $1 billion in net weekly inflows, hit $1.04 billion. And this marks, get this, the 12th consecutive week of positive flows. It pushes the net inflows for 2025 past $18.9 billion already. That's serious institutional capital consistently coming in.
Wow, 12 weeks straight. So Bitcoin's clearly still the leader, but I noticed the source mentions a slight deceleration last week. What does that tell us about investor sentiment, especially with Bitcoin's price getting near those historic highs again?
That's a good point. Bitcoin products themselves recorded $790 million in inflows last week. Still huge, making up 77% of the total. But yes, while robust, it is a slowdown compared to the weeks just before, which were averaging close to $1.5 billion. CoinShares suggests this might indicate investors are, acting with a bit more caution as the price approaches those peaks. You connect that to the broader market cycle, it could signal a period of, let's say, consolidation. The market may be taking a breath before the next big move.
Right, a bit of consolidation. And zooming out slightly, how are the overall assets under management looking for these digital products?
Well, collectively, digital asset investment products hit a yearly high, $188.1 billion dollars in assets under management, or AUM. And Bitcoin dominates that with just over $164 billion dollars itself. So it really begs the question, what's driving this sustained institutional confidence, especially in Bitcoin, even with that slight recent slowdown?
Yeah, good question. Our source points to like a mix of things. Current market conditions, geopolitical tensions playing a role, and Bitcoin just becoming more accepted, ratified even, as a corporate strategic asset. But when you slice it geographically, the picture isn't uniform at all, is it?
Exactly. That geographical breakdown shows some stark contrasts. The U.S. is still the main engine here, attracting over $1 billion in net inflows just last week alone. European countries like Germany, they saw $38.5 million, Switzerland $33.7 million, so positive sentiment there too.
Hmm.
However, look at Canada, they had outflows, $29.3 million left. Brazil too, $9.7 million outflow. This divergence really highlights that while, yes, institutional interest is broadly up, specific regional factors matter. Could be regulations, different economic outlooks, it's not just one global wave.
That regional split is interesting, and here's something else that jumped out at me. Ethereum. While Bitcoin gets the headline flow numbers, Ethereum seems to be building some real quiet momentum with its consistent inflows. What are we seeing there?
Indeed, that's a very sharp observation. Despite Bitcoin's dominance in the raw dollar amount, Ethereum just marked its 11th straight week of inflows, totaled $226 million over that period. But what's even more notable, maybe, is that the weekly inflows into Ethereum products have averaged 1.6% of its AUM during this run. That's double Bitcoin's rate, which was 0.8%. So it suggests a strong relative growth in interest from institutions. Maybe a sign of broadening focus, looking beyond just Bitcoin, perhaps diversification within digital assets.
Okay, so that's the crypto side, fascinating flows. Now let's pivot. Let's zoom into a specific regional economy, Mexico. Domestic policy decisions there are feeling these global ripples and battling their own inflation issues. Our second source, the Seminario Financiero, points to some internal divisions within Banxico, Mexico's central bank. What's the story there?
Yeah, the unity they usually project, it actually broke at their late June monetary policy meeting. One official dissented, disagreed on whether the recent inflation rebound means they should keep cutting rates. So 4 out of 5 members still see room for gradual cuts, probably 25 basis points, a quarter percent next time. But the dissenter favored a pause, basically saying, let's wait until inflation is clearly heading down again. This kind of internal debate really reflects a challenge central banks everywhere are facing. How do you balance growth support against stubborn inflation? makes their next moves a bit less predictable.
That internal debate is really telling. So what exactly is causing this inflation uptick in Mexico, and where do analysts think it's headed soon?
Well, the majority view seems to be that the surge since mid-March is mostly down to temporary factors. Things like, spending around Holy Week, the droughts in northern Mexico hitting food prices, a temporary global spike in demand for medicines, and even some effects from tariff uncertainty leading to inventory building in the U.S., weirdly enough. Now, the annual inflation did decrease from 4.62% in late May down to 4.13% in late June. That's kind of in line with what the central bank expected, but, and this is the key concern, core inflation, which strips out volatile food and energy, kept rising. It reached 4.28%. That's sticky. Analysts mostly expect general inflation to drop back to maybe 3.61% in July, with that core rate slowly, hopefully, declining.
Okay, so temporary bumps but sticky core. What does that mix mean for the next interest rate decision, that August 7th meeting specifically?
All the signs are still pointing towards a rate cut, down to 7.75% at that August 7th meeting. And if the projections hold, another cut could even be on the table for the September 25th meeting. That could potentially bring the policy rate down to around 7.0% by the end of the year. What's helping here is the Mexican peso. It's kept appreciating against the dollar, hit 18.60 last Thursday, up from 18.85 the previous meeting. This stronger peso gives Banxico more wiggle room, right? They can cut rates without fueling inflation quite as much because imports get cheaper.
Right. That makes sense. And beyond monetary policy, what about the real economy in Mexico? How's it performing on the ground?
Well, fixed gross investment, that's a key indicator for future activity, it fell pretty significantly, down 12.5% annually in April. That does signal some concerns about both current and future economic performance. This cooling of the economy, though, driven partly by uncertainty, is actually expected to reduce some internal demand pressure on prices later in the year. So it might ironically help with that inflation picture down the line.
Interesting dynamics. Now, beyond the pure economics, the source also mentions some other key domestic news items for Mexico.
Yes, a couple of things. President Claudia Sheinbaum put forward a constitutional reform initiative. This would give Congress the power to create a general law against extortion, making it prosecutable nationwide. That's potentially a big deal for the rule of law and the business climate. And separately, the federal government has invested quite a bit, 101 billion pesos, to buy harvests directly from small producers, corn, beans, coffee, etc. The idea is to sell these in the government's Bienestar stores, aiming to support local agriculture and improve food security.
Okay, important domestic moves there. Let's widen the lens again now to the international economic scene. What did the latest FOMC minutes, the Fed minutes, reveal about the U.S. economic outlook, particularly that inflation versus labor market balance?
Yeah, the minutes showed a fascinating split among the FOMC members. Some believe high inflation is actually more likely to persist than the labor market weakening significantly. It really highlights that tightrope the Federal Reserve is walking, doesn't it? They also discussed tariffs. Some members see them as just a one-time price shock. But the majority seem to anticipate a more lasting inflationary effect from them. And that's key, because it suggests a view that trade policy itself could be a source of persistent upward pressure on prices, which ultimately affects, what you pay for goods.
Speaking of tariffs, Donald Trump made some big announcements. What are the specifics? And maybe more importantly, what justifications did the source cite for these new trade barriers? Because some sounded unusual.
Yes, definitely headline grabbing. New tariffs effective August 1st. He announced a 35% tariff on Canada and explicitly linked it in the announcement to efforts to combat fentanyl. Then a very substantial 50% tariff on Brazil. And the note on Brazil, as cited in our source, specifically tied this high tariff to criticisms about how former President Jair Bolsonaro is being treated and also decisions by the Brazilian Supreme Court, framing these as attacks on free elections and free speech. Other countries got tariff notices too. Japan, South Korea, Malaysia, Tunisia, Kazakhstan, all 25%. South Africa, Bosnia and Herzegovina get 30%. Jakarta, 32%. Bangladesh, Serbia, 35%. Cambodia, Thailand, 36%. And Myanmar and Laos hit with 40%. The general justification given across the board is the need to correct trade deficits, which are being framed as national security issues. What this really signals, though, is a clear shift towards using trade policy very directly as a tool for geopolitical and economic leverage. This could fundamentally reshape global supply chains, forcing companies to rethink where they produce and sell.
That justification for Brazil is definitely unconventional for a trade policy announcement cited in a financial report, tying it to free speech issues and treatment of a former leader. Does the source give any sense if this kind of non-economic justification for trade policy is a growing trend, and what does that imply for global trade stability?
The report itself doesn't really elaborate on whether it's a trend, per se, but the fact that these explicit political justifications are included is notable. Traditionally, trade decisions are framed in terms of economic imbalances, dumping, subsidies, that sort of thing. When they get overtly tied to specific political situations or human rights concerns, it adds a whole new layer of unpredictability, makes it harder for businesses to plan, increases the risk of tit-for-tat retaliation. It's definitely a factor to watch, moving beyond just the pure economic numbers.
Fascinating and potentially destabilizing. So with all these global shifts, the tariffs, the central bank debates, how did the markets actually react last week? Did they price the stuff in? Any surprises?
Well, last week saw a bit of a pullback in the U.S. The Nasdaq was down 0.2%, S&P 500 down 0.33%, Dow Jones down 0.63%, so slight retreats. The VIX index, which measures expected volatility, actually moderated a bit, down 6.18%, suggests risk perception was somewhat contained, though obviously still cautious. Gold, often that safe haven, gained a little, 0.55%, closing around $3,355 per ounce. European stock exchanges mostly ended the week with gains, interestingly. Asia was mixed. Hang Seng and CSI 300 were up, but Japan's Nikkei and Australia's ASX 200 were down. And just a quick note on China inflation that remains remarkably low. CPI contracted 0.1% month over month in June, only up 0.1% year over year, and their producer price index, PPI, also contracted 3.6% annually. That highlights this persistent deflationary pressure they're dealing with, quite a contrast to the inflation worries in the U.S. and elsewhere.
Right, big contrast. Okay, let's shift gears to something that hits investors' portfolios very directly. Q2 2025 earnings season is just kicking off. What's the early read for the U.S. S&P 500?
So as of July 11th, only 21 S&P 500 companies had actually recorded their Q2 results. Early days. But after weeks of analysts revising their estimates downwards, the aggregated earnings are now projected to grow about 2.5% year over year. Revenues projected up 4.03%. And this is happening, remember, amid those higher tariffs we discussed, and also a depreciating dollar, which can be a mixed bag for profitability. Sector-wise, energy, materials, and consumer discretionary are expected to see the biggest drops in net profit. On the flip side, communications and IT are projected for the highest growth. This big divergence between sectors means the overall market performance is going to really depend on which groups win out and which lag.
2.5% growth. Okay, it's positive, but given those downward revisions, is the market seeing this as just meeting already lowered expectations? And how much of that growth is, real organic growth versus maybe just cost cutting, especially with those tariff headwinds you mentioned?
That's an excellent question. And yes, while 2.5% is growth, it is after those significant downward revisions. It suggests companies are largely clearing a lower bar that analysts set for them. The source doesn't break down the organic growth versus cost-cutting components specifically. But yeah, with pressure from tariffs and general uncertainty, you can bet companies are definitely looking for efficiencies, tightening their belts where they can. The real tell will be the forward guidance these companies give. That's what will give us a clearer sense of their confidence in generating actual organic growth in the quarters ahead. Got it. Forward guidance is key. Now, what about Mexico? The companies listed on the S&P BMV IPC, how are they expected to fare in Q2? For the Mexican IPC, the picture looks quite strong, actually. We anticipate a solid 9.0% year-over-year increase in revenues, a 9.1% increase in UFIDA, that's their operating profit metric, often used for financial firms instead of EBITDA, reflects their cost structure better. And get this, a really robust 22.6% increase in net income expected for Q2 2025. Now, these big jumps are mainly driven by that 13% year-over-year depreciation of the Mexican peso against the dollar we talked about earlier. It really benefits companies that export a lot or have significant operations outside Mexico because their foreign earnings translate back into way more pesos. Financial margins are also expected to improve, which helps boost that net income number too.
Wow, 22.6% net income growth is pretty striking. So with those strong overall projections, does it break down for specific Mexican companies? Any expected standouts or conversely potential underperformers we should be watching?
Yes. The vector analysis coverage included in the source gives some specifics. Based on their analysis, the best Q2 reports are expected from companies like Alcia, Bolsa, Danhos, Funo, La Comer, Payolas, and Gemexico. On the other hand, the most negative reports, or maybe just weaker ones, are anticipated from AC, Kimber, Coco, LivePol, Soriana, and Alpec. So yeah, that highlights some key names for you to watch if you're tracking these specific markets or stocks. Those reports could certainly move the needle.
Good specifics there. Okay, beyond the earnings numbers themselves, our source also flagged some important company-specific news from last week for some big global players. What should we know there?
Yes, several key updates to mention. First, Boeing, BA. Its stock recovered about 6% since that unfortunate Air India Flight 171 crash back on June 12th. The initial investigation seems to be focusing more on pilot actions rather than any failure of the Dreamliner itself, so maybe a measure of returning investor confidence there. Then Tesla, TSLA. They expanded their robotaxi service in Austin, Texas, and they also announced their annual shareholder meeting for November 6th, apparently after some pressure from investors. Shows progress on autonomy and maybe some responsiveness to shareholders. Amazon, AMZN, and Walmart, WMT. The retail giants kicked off their big summer sales campaigns, escalating a price war, really. Prime Day is obviously set to be a major event. Signals intense competition, which could be good for you as a consumer, but may be tough on their profit margins. Apple. Their chief operating officer, Jeff Williams, is retiring. He's being replaced by Saab Khan. That's a pretty significant leadership change in a crucial operational role. Autodesk, ADSK. Reportedly, they're looking at possibly acquiring PTC, which is a software competitor. Talk of a potential cash and stock offer.
Suggests maybe some strategic consolidation happening in that software space. And finally, Costco Wholesale, COSAC. They reported an 8% year-over-year increase in retail sales for the 5 weeks ending July 6th. Importantly, this broke a 5-month streak of deceleration. So quite a positive sign for consumer retail, maybe indicating some resilience in spending.
Lots of moving parts on the company front. Okay, and lastly, for anyone wanting to track the upcoming Mexican earnings reports, the source provided a schedule, right?
That's right. Many are reporting later in July. Some of the notable ones include Walmex on July 16th, AC on July 17th, then a busy day on July 22nd with Alcia, AMX, Kifnor Tyler and Silvisa all reporting. Alpec also reports on the 22nd. After that, we have Gruma and Alpha on July 23rd, Bimbo and Cemex on July 24th, and closing out the month, CHD RUI and Piñoles on July 28th. So plenty to watch there.
Phew, okay. That was indeed a comprehensive deep dive. We've covered a lot of ground from those steady flows into digital assets to the complex balancing acts in central banks like Mexico's, the escalating trade stuff, and now the buzz around earnings season. We've really tried to uncover those interconnected forces. Hopefully this helps you navigate these markets with a bit more clarity.
Absolutely. We've seen how institutional money keeps finding its way into crypto, the delicate dance Banxico is doing with rates and inflation, and that really intricate web of global trade policy shifts and earnings expectations. The interconnectedness really stands out, doesn't it? Especially when you think about how these ongoing trade policy changes, like the new U.S. tariffs, are likely to ripple through corporate results and maybe even consumer behavior in different regions over the next few months. It's such a dynamic landscape. One policy move can really have these cascading effects.
So what does this all mean for you, listening in? I think it means understanding that the global economy isn't just one single thing. It's this dynamic interplay of regional strengths, policy choices, market psychology. Keep an eye on those divergences we talked about, like in crypto investment flows or the debates inside Banxico. And definitely watch those earnings reports as they unfold, because that's often where the real story gets told, how these big macro forces actually translate into performance for individual companies and sectors. Join us next time for another deep dive into the sources that matter most to you.